And welcome to Trading Day. Roger Peterson. Thank you very much for joining us today. I appreciate it. Let's get to some stories we're following for you in the BNN Bloomberg newsroom. Shares of Dollarama are seeing some pressure today. It's off 7.6, almost 7.7%. That's after the discount retailer posted same-store sales in its latest quarter that came in below estimates. Dollarama says unfavorable weather conditions negatively impacted store traffic. On the upside, it beat profit and revenue expectations and boosted its dividends. Shares of Boralex are getting a boost, up 8.5% after the renewable energy firm confirmed it is conducting a strategic review of the company. Bloomberg is also reporting that the options could include the company going private. Boralex has a market value of about $3 billion and has a number of new projects in development. It builds and operates renewable energy production sites in North America and Europe. Shares of GoEasy are trading higher today. The Canadian firm has won concessions from its lenders to keep key funding lines open amidst weakness in its auto lending business. That unit saw a surge in loan losses. GoEasy is also delaying its earnings report. Now, earlier this month, it suspended its dividend, withdrew guidance, and disclosed about $331 million in charge-offs and write-downs for the fourth quarter. And looking at the markets right now, the TSX still rallying up 0.65%. It's about a split. Energy is leading the way along with utilities going the other way. Consumer discretionary off by 2.1. Same with tech. South of the border, you can see a little bit of a mixed bag there. A lot of unsurety, people not sure where they're heading, what to do with everything that is unfolding in the Middle East. S&P 500 down, pretty much a wash though, up by 0.1. Dow Jones Industrial Average up by 0.13, and the Nasdaq is off by 0.6. Well, our next guest says his company's top-down dashboard has shifted to neutral and highlights movement in energy, metals, and tech. Here to get more in-depth on this and daily market trends is Bruce Campbell, founder and portfolio manager at Stonecastle Investment Management. Bruce, thanks as always for joining us.
Yeah, thanks for having me on.
Okay, you're in neutral right now. Where are we going if we're in neutral? What are we doing?
Yeah, I mean, when we move into neutral, what that means is that we raise up our cash positions inside of our portfolio. And how we do that is any positions that are in our portfolio that start to break down, we sell them, but we don't replace them with anything new. So that builds up our cash levels. And right now, we sit with about 20% of our portfolio in cash.
Okay, I was going to ask where you're moving at with cash. And is it really a sit and wait and see right now? Still, even we've seen some movement today. We heard that news yesterday. The market reacted, but still too volatile?
It is, yeah. I mean, we look at a couple different things. So if you just look purely at the volatility index, you see that still, is elevated above that 20 level. Anytime it's in that sort of 20 to 30 level, it becomes, very volatile up and down. And then above 30, it's almost impossible to know what the market thinks. So right now we're still above that 20 level. We'd like to see it settle down below that 20 level before we would then start to look at putting some of the cash that we have back to work into the market.
But for now, it's sit and wait. Now you're seeing weakening breadth, narrowing leadership. You're thinking those are the causes. Where does that come from?
Well, I mean, the causes really, have to do with what we've seen in the Middle East, and that's just so much uncertainty as far as what's happening economically with the price of energy, what impact that has on inflation. And, the market and investors are trying to figure out, is this going to be a shorter term event or is it going to be a longer term event? And if it is a longer term event, eventually the market itself starts to discount that. But right now it's such a dynamic situation that it ebbs and flows, and there's news that comes out daily and even intraday that has an impact, and it just freezes investors so that either they want out or they want into the market. And we need that to kind of settle down before we would look at, investing. And so that broadening or that narrowing happens when the news changes in either fashion.
All right, now, not surprisingly, energy is your top ranked sector right now. What's right about it and what could be wrong about it?
It's interesting that, we actually started to see energy moving up our ranks. If you remember what we do at Stonecastle, we rank about 3,800 companies in North America. And we started to see that the energy companies moving up in the ranks actually back in November. So it was even before this was an event that we started to see energy ranking better on our system. And then, of course, when you saw what's happened to the commodity prices of energy and natural gas, then it really has exploded. What can go right from here? Well, there's actually an interesting survey there, a study that Sentiment Trader had done that we saw when oil moves into a backward state as it has and has had such a big spike. What happens to the oil price is really, questionable, especially when they looked out over past history. But what happens to the energy stocks is that, over a 6 and 12-month period, they actually are higher from when that event happened. So we feel that, we could continue to see stronger energy prices or energy stock prices over the kind of intermediate longer term. In the short term, that's where it really becomes, kind of anyone's guess and what happens with, with the geopolitical events. And yesterday was a good example. One tweet and oil was off over 10% on the day. So there's going to definitely be some volatility around news flow and what happens there.
All right. And then, of course, in the middle of this going the other way, precious metals. I think a lot of people might have thought people would be turning to it as a safe haven, but that is not the case right now.
If anything, I think it looks like what's happened is, specifically when you look at what's happened with both bonds and precious metals, is that it's been used as a source of liquidity. So people have raised cash in portfolios in places that they could. So what was most liquid? Bonds. Gold has had, such a big move, and there's a lot of people that are sitting on profits. So that was also an area, and so that's introduced a lot of volatility, certainly into the gold sector. And you've seen, this month, the gold stocks and the material stocks on the Toronto Stock Exchange have really been hit hard.
And are we nearing the bottom for now, do you think, or is there more room?
Well, if you look at it from a sentiment standpoint, it's now starting to get to that place where sentiment starts to form that bottom, but sentiment can't be used as a timing indicator. It's just a condition. And so we could look at that and say that's one of the conditions that we see in place now, and we'll have to continue to watch and see follow through on the technicals. What we probably want to see as follow through is that, gold starts to stabilize. It had some pretty big up and down movements if you go back into February, and then into March here, it's had mostly down movements. And what we need is probably a period of stability where it doesn't do a whole lot and just starts to build that base before it, can start its move back up again.
All right, and last, tech. Remember that we were talking about tech all the time. Tech was everything, and it's disappeared kind of to a degree. Where are we sitting with that right now, do you think?
Well, the interesting thing with tech is that there's still a lot of tech companies that are doing phenomenally well, both from an operation standpoint, but also from a share price standpoint. But what we've seen is a bit of discrepancy there. So we saw, if you go back sort of 36 months to 12 months ago, the earnings acceleration was really on the large cap side. And now we've started to see that come down cap. So we've seen some of those smaller companies with the earnings acceleration that's at a faster pace. And the large cap stocks, it's not that their earnings aren't still growing. It's just that the rate of change of those earnings growth has started to slow down. And then as a result, we've seen investors start to look for other areas with faster growth. And so, if you look at the large technology stocks, as an aggregate, certainly there's always pockets that have done well, but some of them are just kind of going flat to mildly down. And you're seeing some of the small and mid-cap technology stocks doing phenomenally well here.
All right, we have to wrap it up there, Bruce, but thanks very much for joining us as always.
Yeah, thanks so much.
Bruce Campbell, founder and portfolio manager at Stonecastle Investment Management. Coming up, concerns about private credit markets and possible spin-off effects have been rattling the markets. That's next. Private credit has been in the spotlight as retail investors have been rushing to withdraw investments from private credit funds, and many funds have responded by limiting those redemptions. This includes two of the biggest names in private credit, Ares Management and Apollo Global Management, which blocked investors from getting even half of the money they wanted. Here to give us his perspective on the private credit landscape is Michael Anderson, head of credit strategy at Citi. Michael, thanks very much for joining us.
Thanks for having me.
All right, I've got to get this in off the top. I love this. You call this the private credit's roaring 20s. Are we going to see the Great Gatsby coming in? What do you mean by that?
Yeah, as well as a guy from Long Island, very, very familiar with Great Gatsby. I think it's we began the decade with a lot of tailwinds lining up to drive private credit forward, to help encroach upon what the business that banks were doing. They were able to provide a lot of solutions that lenders wanted, that borrowers wanted. So certainly, something that was set up for a nice boom. Now the question is, are we going to get a bust that follows that boom?
And so which way are we heading? Are we on the bubble? Could it go either way right now? What's your feelings on that?
It's a great question. So the way I look at it is there's a couple of different things that are going on. In the short run, we're worried about, some of the lax lending standards and borrower misrepresentation. Could there have been, a shortage of proper due diligence? My sense on that is that's fairly contained. The bigger question and the longer term question is the AI disruption theme. So we've seen software equities, software bonds sell off a lot, and private credit has significant exposure relative to public markets. And so right now we're still in significant price discovery mode. But in the next year or two, we're going to figure out which of these business models are going to survive and which aren't. And in the which aren't, is there going to be decent recoveries? In other words, are these assets going to be worth something in restructuring? And that's really what we're all looking at. But I think to your point is there are certain things that definitely give you pause. Number one, average credit quality is generally low single B. The agencies don't give ratings, but they do provide credit estimates. And that generally is very concentrated in low single B. So that's fairly deep in below investment grade. Number two is you have a fairly short maturity wall. And so some of these deals are going to have to be dealt with over the course of the next year to 2 years. There's a lot of 2027, 2028 maturities. And then you have significant exposure to potentially AI disrupted sectors, software, services, and potentially others that might, the AI theme is evolving very, very rapidly. So we'll see in the coming quarters. But there are definitely certain factors that are set up for a significant default cycle.
Yeah, I was going to say, it sounds like there's a lot of money coming due. Is the money going to be there?
Well, credit's a confidence game, right? And so right now, the public markets are telling you that the confidence isn't there, right? The BDCs are trading at 80% of the listed BDCs are trading at 80% of their NAVs, which is driving some of the non-listed BDC outflows. That's certainly very, very natural if investors are looking to get their money back. But we're going to see, and the good thing about these companies is they don't borrow every single day. They don't even borrow every single month or every year. So we have a long lead time to figure out exactly what the disruption is going to look like. For the time being, the BDC managers highlight that these companies are performing according to budget. Their EBITDAs are growing. But our concerns aren't over, the last quarter or the next quarter or two. Our concerns are a year or two out. And as we've seen, the AI theme is evolving very, very quickly. I see it how we're using it in our business on a day-to-day basis. So let's see what it's going to look like in 3 to 6 months. But clearly there's elevated risk as highlighted by public marks.
And let's talk a little bit more about the AI. Just how much of an impact is it having, and what is the potential impact that people feel this could have?
Yeah, so right now, as the BDC managers will highlight that these companies are performing exactly how they're supposed to perform. EBITDA is growing. These companies are expanding. The problem is that if you have a 2028 or 2030 maturity, are you going to be able to roll that debt over? And so that's really the question everyone is trying to answer. For what it's worth, in our recommendations, we're underweight the sector within the public markets that we have recommendations for. Private markets obviously are a little bit different, just in given the nature of the companies in those markets. But it's a space that we continue to be very cautious on. We view there being significant positioning risk, that people were so comfortable with the risk that they went in fully, and so there's really no back bid for this. So if conditions change, the holders have a limited universe of sellers at palatable levels to sell these assets.
And have we seen a situation like this before, or is this a first?
Yeah, I mean, I think probably the closest thing that you'd have is around the turn of the century, when we had the telecom and tech bust, where there was just a lot of build out, and there was a lot of lending, and on the other side, a lot of these assets weren't worth all that much because people couldn't monetize it. In that's probably the closest thing. But this is more like a potential melting ice cube, where companies are performing perfectly well, but maybe in the next 2 or 3 years they get disintermediated by a technological revolution like AI. So, the one thing about cycles is that they're different enough that if you knew about one cycle, it doesn't necessarily help you in another cycle. I mean, we tend not to make the same exact mistakes that we made the last time. We tend to make new mistakes.
And now, what's the regulation in here? It feels a bit Wild West. Is there a lot of regulation or no?
Well, one of the reasons why a lot of this lending went private is because there was more flexibility. Now, I think managers would say to you, well, we're not going to do the deals. Like, there's not a good marketing, a good marketing scheme to say we're doing deals that the banks can't do because of regulations. But certainly that certainly was a factor in terms of regulations tend to be a very blunt instrument, and so one size doesn't fit all for all deals, and that's one of the things that allowed private credit to build. And then the other thing was, when the Fed was hiking rates in 2022, it was just the banks had gotten long some LBO risk at a time when everything was just being pulled back because the Fed was hiking rates. So some of this is a timing issue as well in terms of allowing private credit to grow the way it has in the 20s.
All right, we have to wrap it up there, but Michael, thanks very much for joining us.
Thank you for having me.
Michael Anderson, Head of Credit Strategy at Citi. Up next, we discuss some tips for investors on how to navigate a volatile market amid geopolitical uncertainty. Well, the Iran war has been driving market volatility and higher oil prices. With that increasing geopolitical tensions, they're impacting investment decisions. To understand how to navigate your portfolio in an uncertain time, we're joined now by Janine Gunther, Portfolio Manager at Bellwether Investment Management. Janine, thanks very much for joining us.
Hi, Roger. Thank you for having me.
It is, what's the old adage? May you live in interesting times. We're living in some interesting times right now. How are you approaching this?
Well, Roger, first and foremost, this conflict is so personal for many Canadians, including the people in my own community who have family in Iran. I want to acknowledge first how unsettling it is to be waiting for news of their safety. My heart goes out to them. I think when we look at markets like this, as you mentioned, interesting times, the financial lens is to make an important distinction between what feels frightening and what is financially actionable.
And sorry, go ahead.
I was just going to say that geopolitical crises often create short-term volatility. Markets can move sharply. We saw that yesterday and again today. And over time, these dislocations can mean good, strong buying opportunities for disciplined investors.
And where are you putting your focus right now with those opportunities?
Well, we really try to take a look at companies that are going to be winning for the long term, financially strong balance sheets, good cash flow, number one or number two competitors in their space. And sometimes in markets like this, you can find those opportunities on sale.
So just quickly, when you're talking long term, what's your version of long term?
So long term is 5 to 10 years or even longer. Right now on the minds of Canadians and investors around the world is inflation. Consumers remember high gas prices. They get nervous about interest rates for their mortgages and food. People remember scarcity. They don't remember abundance. And so we try to think about things that have sold off, that play great dividends, and have great competitive positioning.
And so with everything that's unfolding, which sectors or which particular stocks are catching your eye right now?
Well, we really are asset allocators, and we like to take a look at long-term technology plays, long-term financial plays, and these are opportunities for us to add to portfolios for clients, whether they're starting with us or continuing.
Now, the long-term technology right now must be quite the challenge.
For sure. We are taking a look at everything we use. As the last guest said, we use artificial intelligence to help us every day, and we're finding new things, and it's changing our landscape. At the same time, it's making us better. Things that used to take us a long time to do don't take us that long anymore, and we just are finding that there's great opportunity for us.
And with everything that is, it just feels like we've been going almost from one crisis to another in the last little while. But with what is unfolding in Iran, there's no end date. We don't have an end date set for this. We hear maybe, we hear it's going to, then it's not. How are you making any moves right now, especially as you look long term? Are you mostly just kind of sitting on, how much do you have sitting on the sidelines, and what opportunities are you looking at within just this conflict or within this shorter window?
Well, to be very honest, Roger, I don't invest day to day. We take a look at the long-term opportunities for our clients and their cash requirements, and a combination of long-term growth and short-term dividends allows us to create the cash flow for people. Everybody is different. Some people are just trying to get to financial independence. Some people are trying to support children and grandchildren, and they're doing succession planning for their businesses. It really, when the headlines happen, that doesn't change our discipline and our principles, because that really doesn't change the cash flow requirements for our clients.
And do you have one favorite one that stands out for you that has been a nice long winner for you?
Well, to be the long-term winners, I don't like to pick a specific stock, but I do like technology longer term. It's something that I use every day. Every one of us uses it every day, and there's an opportunity for us to add to this in the long term. All
right, Janine, thanks very much for joining us today. We appreciate it.
You're welcome. Thank you.
I love that backdrop behind you. It's got to be West Vancouver. Janine Gunther, Portfolio Manager at Bellwether Investment Management. Still ahead, a Canadian startup closed an oversubscribed $10 million Series A this year on its work in hormonal health care. We'll talk to the founder after this. Shares of Dollarama are seeing some pressure today after the discount retailer posted same-store sales in its latest quarter that came in below estimates. Dollarama says unfavorable weather conditions negatively impacted store traffic. On the upside, it beat profit and revenue expectations and boosted its dividend. AtkinsRéalis has received a contract worth approximately £98 million from Britain's rail infrastructure owner Network Rail. The Montreal-based company will work to upgrade signaling and telecommunications infrastructure in South England. Atkins will also deliver end-to-end design, project management, and construction services over 3 years. Shares of Estée Lauder are taking a hit. The company is in talks to buy Pooch Brands in a deal that would create a cosmetics giant with about $20 billion US in annual sales. The takeover of the Spanish company would give Estee Lauder access to well-known perfume and fashion brands, helping it compete better against rival cosmetics giant L'Oreal. And looking at the markets right now, well, TSX slipping a little bit, still in the green, but off from what it was around the early lunch hour. It's up about a quarter point right now. The U.S. markets, they've been kind of all over the place, and that's where they are right now, all in the red. S&P 500 off by a quarter. Dow, it's about a wash right now. And the NASDAQ is now dropped 0.84%. Hormone health is emerging as a major frontier in healthcare, and one Canadian company is making its mark after raising an oversubscribed $10 million Series A to scale its personalized, data-driven approach to treating hormone-related conditions. For more on the company, we sat down earlier with Hira Siddiqui, the founder of Science and Humans.
Science and Humans is Canada's largest digital health platform that specializes in hormone health for both men and women across different life stages. And our approach to delivering care is very unique in the industry. And that is essentially why we are becoming extremely successful in doing what we do today. We combine clinical protocols with wearables, insights, and biomarker data to deliver hyper-personalized care digitally at scale. That's essentially what we've been doing for the last 5 years, delivering care both direct to consumer and through large insurance companies and other distribution channels.
What's your major target market? Is it the end consumer? Because the end consumer is becoming more and more interested. Hormonal healthcare is hitting the news in a big way here. Or is it the healthcare companies?
It is the end consumers in our D2C, distribution channel. Consumers are buying our services directly on our e-commerce website. However, on the B2B side of our business, our consumers, the customers are large insurance companies and large employers. Of course, the healthcare consumers are employees of those organizations, but in that channel, essentially the healthcare services are purchased through insurance companies and employers, so both.
Now, you say you cover both male and female and a broad age. Are you not worried you're spreading yourself too thin trying to do it that way?
It's a really great question. We started off in a certain demographics of the market. We didn't start off with providing solutions across different demographics. As we scaled and the infrastructure built over time, both in terms of technology and scale, and our medical team exposure and expertise grew over time, we saw that the need was very well required across all different life stages, and both in men and women. The challenges are quite unique and different. And at the same time, there were challenges experienced by all of these demographics looking for evidence-based solutions in the market and seeing significant challenges in doing so. So over time, our organic growth strategy allowed us to cover all demographics and then both males and females. But we started off doing midlife first and then grew from there.
What about regulation? Is the regulations becoming more friendly, allowing you to do more of this, or is the government starting to really clamp down in this area as it grows?
No, we find ourselves extremely complementary, not essentially competing with the services available through the community providers today. There is a gap that is recognized both by the regulatory and through the B2B channels, insurance companies and employers, since they are very evidently today experiencing and observing productivity loss in their workforce and in employees. So we actually find ourselves extremely complementary, and we have so far not experienced any regulatory challenges.
And going back to your $10 million, the Series A, what made you decide on $10 million? And you oversubscribed, or were you surprised to see that?
We were not actually surprised to see that. Our journeys, I can, say that perhaps was a little bit different and easier relative to some of the other founders. We had been in this space for a few years, so essentially we had a proven track record of execution. The traction was there. We had some of the largest contracts with major insurance companies in Canada, and over 60,000 members on the D2C channel had already subscribed to our services. So we had a very healthy P&L. We were a cash-generating business. The requirement for the fundraise or the Series A was essentially to bring the money to fund our next stage of growth and really build that next generation experience in terms of technology and infrastructure that consumers are looking for in digital health solutions today. But in terms of our subscription round, it was very well expected, and we are very proud to have some of the largest, most supportive investors today in the healthcare segment and industry today in Canada.
Now, you cover a wide target market. Are you finding there's more young people being interested in this? Because hormonal health used to be more of a concern for older people, but I get the impression that younger people are starting to get more interested in this.
That's a really good question. So I'll break it down into two. Especially, it's very evident and perhaps commonly known that hormone health does decline with gradual and natural age progression, both in men and women. So the demand and the requirement for hormone health evidence-based solutions is, of course, is a proven model in midlife and beyond. But on the younger demographic side, younger women in their 20s and early 30s do experience an entire spectrum of hormone health conditions as well, with PCOS, PMS, PMDD, infertility-related conditions. And those are all conditions that are experienced by younger females. And then on the younger male side, it's not very frequently spoken, but there are many different reasons why younger males are also starting to experience hormonal dysregulation because of the endocrine disruptors in our environments today, with stress and lack of movement and exercise and nutrition. These all essentially can become contributors to suboptimal hormone health conditions in younger males as well. So we have essentially access to some of the most brilliant minds in the industry in terms of medical advisors that are top endocrinologists, gynecologists, regenerative medicine experts that help us build these solutions that are extremely evidence-based. So we have protocols that are built both for younger males and females, and then midlife and beyond individuals as well.
That was Hira Siddiqui, founder of Science and Humans. Coming up next, Canada's Energy Minister Tim Hodgson says he has spoken to U.S. officials about shipping more natural gas to the U.S. for LNG export and to support AI data center demand. We'll bring you his sit down with Bloomberg's Julie Fine after this. Canada's Energy Minister Tim Hodgson says he has spoken to U.S. officials about shipping more natural gas to the U.S. for LNG export and to support AI data center demand. He spoke to Bloomberg's Julie Fine at CERAWeek in Houston.
The IEA says if you are a net importer of oil, you need to have reserves. Canada is a net exporter of reserves. So, for example, the United States, you're the biggest producer of oil in the world. You produce 12 to 13 million barrels per day, but you use 20. Let me be really clear. You produce 12 to 13, you use 20. 63% of that difference comes from Canada. Canada exported almost 4.5 million barrels to the United States last year. How we will do that is increase our net exports. We will do that by asking all of our producers to get to the maximum production they can and to delay turnarounds. As you may be well aware, many of the oil sands producers have to do turnarounds on their plants and facilities. We've asked our producers to delay those turnarounds so they can keep producing. Typically, a Canadian oil sands producer takes that turnaround time in Q2. Right now, we've asked them not to do that so that they can keep producing and sending oil both to the United States and also to our allies around the world. We ship over 1 million barrels a day to the West Coast. 60 to 70% of that oil goes to our allies in Japan, in Korea, and other parts of Asia.
Any pushback from your producers?
No. Canada, as I've said yesterday, Canada doesn't use energy for coercion. Canada uses energy as a unifying force. We want to help the United States make sure that those barrels keep flowing to the United States, and we want to help our allies around the world.
Can you detail any conversations you're having with the Trump administration about this during the war with Iran?
We had a wonderful conversation yesterday with Secretary Wright and Secretary Burgum about how we're doing everything we can to keep those barrels flowing. As I just talked about, we send almost 5 million barrels a day to the United States, also on natural gas. So the U.S. is exporting natural gas to the world right now. You export about 20 billion cubic feet a day. One of the reasons you can do that is you import 8 billion cubic feet a day from Canada. If you look at the Pacific Northwest, 90% of the gas the Pacific Northwest uses comes from Canada. If you look at Chicago, 40% of the gas in the Midwest comes from Canada. If you look at Northern California, over 40% of the gas that's burned in Northern California comes from Canada. We talked about how we could help send more gas down to help you export more off the Gulf Coast and to help you with your AI strategy. Obviously, a key component of winning the AI race is building more data centers. That requires more natural gas. We can provide that natural gas.
Do you feel you came to some agreements about that walking out of there?
We have a shared vision. We talked about Fortress North America. Look, our two countries are our best customers. We sell you lots of crude and natural gas. You sell us refined products. In Eastern Canada, you sell us gas from the Marcellus. We're stronger together than we are apart. And so we talked a lot about Fortress North America.
At a critical moment, allies, of course, in desperate need of oil, Canada's ability to supply it, it is limited by pipeline infrastructure. Let's talk about ongoing talks with Alberta. How much closer is Canada to construction on a new pipeline to the Pacific?
So we have what's called a memorandum of understanding with Alberta about how we move forward on that. As you know, we built a new pipeline to the West Coast, the TMX, that came on stream in 2024. We're already talking about expanding that pipeline. We built a natural gas pipeline to the West Coast, the Coastal Gas Link, which is now firing the only LNG plant on the West Coast of North America, which is coming up to speed. That's really important for our allies. We have a series of discussions going on about another 1 million barrel pipeline to the West Coast, and we're heads down working on that, and we're confident we're going to get there.
On that pipeline, though, you've said that the government does not want to fund the new West Coast oil pipeline. Are you getting interest from the private sector?
So that pipeline, the proponent of that's going to be the government of Alberta. The government of Alberta is working with multiple different pipeline private sector companies right now. They're the proponent. They've said they'll be ready to come to us in June of this year with that proposal. And when they do, we'll evaluate it. And we have a shared goal of trying to help our allies get more oil.
Your government supports a new oil pipeline to Canada's West Coast. But for that to happen, you've said that companies must build carbon capture in the oil sands. You've set that April 15th deadline. Do you think you'll meet it?
We are in intense discussions right now. I was talking with Premier Smith yesterday. I am confident we share a goal of building the biggest carbon capture project in the world. It's called the Pathways Project. It would take 16 million tons of carbon a year out of the atmosphere, and it would significantly reduce the carbon intensity of all of our barrels. When we do that, we have the ability to add millions of barrels a day of production and build that pipeline to the West Coast.
Bloomberg's Julie Fine was speaking with Tim Hodgson, Canada's energy minister. Still ahead, today's market movers with Bloomberg's Matthew Griffin. Well, Know Your Options is back. Tune in Wednesday at 3 p.m. Eastern to have all of your options trading questions answered by Chris Tom of Moat Financial. Send us your questions at knowyouroptions@bnnbloomberg.ca. All right, time for some movers south of the border. We are joined by Bloomberg Equities reporter Matthew Griffin. Matt, thanks as always for joining us.
Thanks for having me, Roger.
Okay, Atlassian, I think probably one of the many softwares taking a hit right now. Amazon dropping a bomb.
Yes, so Roger, this is just the latest big sell-off in the software space, and Atlassian, one of the notable decliners, down more than 8%. Also look at companies like HubSpot, for example, they're falling. And yes, there was a report from The Information about some AI tools that Amazon is deploying, actually replacing the functions of some employees that they laid off recently. For example, helping sales representatives answer technical questions for customers. Also had some news out of Anthropic, which has some new tools in its Claude models. They can access users' computers in new ways. And of course, it's anyone's guess whether this will affect companies like Atlassian directly. They make workflow management software like Trello. Is that really going to be threatened by these new tools that Amazon has developed? But investors are really nervous about AI disruption right now. Software is at the epicenter of that. And it feels like on Wall Street, you get this reaction where investors see headlines about AI, they click over to the software part of their portfolio, and they start hitting sell.
Yeah, this might be either the end of software or one of the greatest buys of software ever, the way people are being scared off by it. And it really is hard to tell which way it's going right now. Well, we know where Netgear is going after the U.S. blocked imports of many foreign routers. Just how much of the market could they conceivably own with this?
You know, I don't have exact market share numbers in front of me. That said, this is a really interesting situation from Netgear because it will actually depend on how regulators choose to treat the company. Their routers are technically included in this order, or new models they manufacture in countries like Thailand, for example, like Vietnam, but they do not manufacture in China. And this order from the Federal Communications Commission is seen at taking aim at China for national security reasons. And analysts at Stifel say Netgear is going to likely get an exemption here and likely going to benefit as a result. It's probably going to hurt some competitors like TP-Link. That's a company that's already been under scrutiny, facing investigations from the Trump administration for national security reasons, although worth saying that they say they're confident in the security of their supply chain.
I like Stifel's comment. It's well positioned. It sounds like it could be right now, couldn't it? Okay, stablecoin issuer Circle having another bad day since it went public. The Iran war hitting the crypto markets. They've been taking a rocking, aren't they?
Yes, Circle actually not just having a bad day, but on track for its worst day since the company went public in June. Now, of course, Circle's still up about 200% from the IPO, but this is just the latest example of the way the crypto ecosystem has changed, the way investor sentiment is faltering. You have Bitcoin sliding today, other peers such as Coinbase, and Bitcoin now down almost 50% from an all-time high set in October. This is something you and I have talked about. Crypto has held up okay during the war in Iran, but is not really working as a haven asset in the way investors have hoped, in the way that investors really see being part of the thesis for crypto, and that is letting people down.
Yeah, it still doesn't have a track record, does it, for a lot of people? They want to see more from it.
No, and if it does have a track record, it's for volatility. And sometimes you want that as an investor. Sometimes you want to chase risk. But if this is going to be digital gold, then these sharp up and down swings, bull markets followed by crypto winters, not what investors are looking for there.
All right, but then you look at gold, it's going a bit crazy right now, depending on which day you look at it. Okay, Matthew, we got to go. We're out of time. Fair. Thank you, as always, for joining us, sir.
Thanks for having me, Roger.
Bloomberg's Matthew Griffin. Now that wraps up this edition of Trading Day. Thanks very much for joining us. Enjoy the afternoon.